Today we're talking about the basic structure of accounting, still under the series of accounting for beginners. So first things first, a business transaction has to occur. What is a business transaction? It's simply an exchange of goods or services in return for money. So when business transaction occurs, business transactions are in two forms. It's either it occurs cash, which you are paying immediately, or it's in form of credit, you pay later. So when cash business transaction occur, it's going either to the cash book and ledgers. Credit transaction goes to the prime books and ledgers, just to establish that. Now, once a business transaction occur, the first thing you receive as maybe a buyer is one of the source documents. So source documents includes invoices, receipts, petty cash vouchers, debit notes, or credit note. This is not all encompassing. Now, invoices gives a detailed summary of the transaction, the business transaction which has occurred, which includes the date, the description of the item, the amount, the total. Receipt is a proof that payment has been made. Once you pay in form of cash, you get receipt immediately. Petty cash voucher are used for little items, for petty, just as the name says, for petty transactions. For example, in a business, you want to buy maybe biro, you want to buy your stationaries and the likes, just for petty items, goes to petty cash vouchers. We have debit notes, a note given when there has been a case of an undercharge sent by the seller to the buyer when the buyer has been undercharged. Then the opposite credit note when the buyer has been overcharged. Now, these are source documents. From source documents, we move to books of prime entry. Now, or also known as books of original entry. Now, I remember I made mention of the fact that when business transaction occurs and you pay credit, you're not paying immediately, you're paying at a later date. It means it's a credit business transaction. So those nature of transaction goes into the books of prime entry. We have the sales day book, we have the purchases day book, we have return inwards day book, we have returns outward day book, we have the journal proper, and we have the cash book. Now, the sales day book, as the name implies, sales day book are books of original entry that records credit sales transactions. Return inwards day book are used to record transaction when your customer return goods but purchased from you as the seller, which can happen when maybe the goods did not fit the description of what they wanted or they are damaged. Return outwards records transaction in which the I, as a business organization, I return back goods I purchased from my supplier. Still the same thing, maybe it don't fit my description or it has also been damaged. Journal proper is used to record, because these are talking of sales, purchases, return what goods. Journal proper, one of the things that record under journal proper is purchases of fixed assets. Then cash book is used to record cash transactions. So these are the books of prime entry. So they record credit business transaction. So it goes to credit business, it carries credit business transaction are recorded in books of prime entry as well as ledgers. Then after we have established this, we come to the double entries in ledger. Now remember I said that I've already uploaded a video that talks about double entry principle. It simply states that for every credit entry, there must be a corresponding debit entry and vice versa. So double entry in ledger, they are either posted to books of prime entry or private ledgers and personal ledgers, as the case may be. It's simple. So we start from business transaction. You either purchase cash or you pay credit. Or you either pay cash or you are going to pay later, which is credit transaction. From there, once a business transaction occurs, they are given what? So it goes into the source document as a proof that business actually was transacted. Then from there, it enters the books of prime entry, which is either the sales or purchases day book, which if they are credit business transaction, the return inwards or outwards, journal proper and cash book. The next thing is to post in the appropriate ledgers. Books of prime entry falls under here, private ledgers and personal ledger. Of course, private ledger involve maybe sold goods to Okon. use sales, account accounts, private ledgers, and personal ledgers, drawings accounts, personal ledgers. Then after double entry has been done in the ledgers and all all ledgers has been closed, the next thing is to post into your trial balance. A trial balance simply tests the arithmetical accuracy of your double entry system. So it means after doing your double entry principle, debit, credit, maybe account A account, and B account, as the case may be, and all ledgers have been closed. We're going to have examples on this. Then thereafter, you post into your trial balance. Now, I state again that it tests the arithmetical accuracy of your ledger posting, of your double entry postings in the ledger. Trial balance is simply, it has, just as a rough sketch, it is written done this way: debit, credit, then maybe SN, particulars. So for all ledgers that you have opened, you come here, for example, cash account. Cash account, if you have watched my first video when I talked about the rules of accounting, it's always a debit account. So the final closing of that account will also always be on the debit side. We have maybe creditors accounts, creditors. If you have watched that video too, you know that creditors have a credit account. They are a credit account. So what is Tribalance trying to tell you? If you have accurately posted all transactions, knowing fully well that transaction affects two accounts, a debit and a credit, and after closing all your ledgers, you come here and put the final balances in your trial balance. It means at the end of the day, if your debit side and your credit side is having the same value, it means that to a very good extent, the arithmetical accuracy of your double entry principle is correct. Now, of course, there are some errors that does not really show that there are some errors that do not affect the agreement of the trial balance, which means that your debit and credit side may be the same figure, 20,000, 20,000, but your ledger posting is already wrong. We're going to note those errors when the time comes. So after preparing your trial balance, the next thing is to prepare your trading profit and loss account. Of course, the essence of preparing the trading profit and loss account is to ascertain your gross profit, which is the credit side, and your profit and loss. Your gross profit, not the credit side, sorry. Your gross profit, which is your trading account, and your profit and loss account shows you your net profit. So that is final account of a company, trading profit and loss account. Of course, in a layman term, because now we know it's called statement of comprehensive income. Then next, after preparing your trade profit and loss account, you prepare your balance sheet or statement of financial position. It shows the position of your assets, liabilities, and equity as at a particular point in time. So that is what balance sheet is all about. Then thereafter, after preparing your statement of financial position or balance sheet as the case may be, we talk about interpretation of financial statements. So the financial statements that have been prepared, what does it mean? By, of course, interpreting financial statements is all about calculating your ratio, which is simply your ratio analysis, and interpreting it thereafter. So this is just a basic structure of accounting, like from inception to the end, because the main purpose of accounting is what? To pass information to your stakeholders, shareholders, and other stakeholders in the business. So it starts from when business transaction has been done up until you are interpreting the financial statement that has been prepared. So let me run through this diagram again. First things first, I said that when a business transaction takes place, it takes place in two forms. It's either cash, you are paying immediately, or credit, you are paying later. Once a business transaction occurs, the first thing is your source document. The first account which takes that transaction is your source document. No, now we talk about source document. They are documents that record business transactions. So invoices, receipt, purchase cash book, debit and credit notes. Then from source documents, we go to books of prime entry. Now, I said that books of prime entry is basic, or books of original entry, as the case may be, mostly captures credit transaction, with the exception of cash, with the exception of this cash book. So we have sales day book and purchase day book, return inwards and outwards day book, journal proper, which captures purchases of fixed assets, because of course you can't record them in all these in other books. Then after your books of prime entry have been captured, we are talking about double entry in ledger, the double entry principle. I've talked about this, that for every business transaction, there is one account is receiving, one account is giving out. So you record them, either it is going to be affecting either the books of prime entry, private ledgers, and personal ledger. Two out of these listed three items, one will be debited and one will be credited. Then once your double entry has been done in the ledgers, you close your ledgers and you prepare a trial balance. Now, a trial balance is tests the arithmetical accuracy of your double entry postings. Once you have confirmed that your trial balance is the two figures are correct, that the debit and credit side has the same figure, which it is not in all cases that the that the trial balance is balanced is correct, doesn't mean that your ledger posting is correct, because there are certain errors that affect trial balance and there are also errors that do not affect the accuracy of the trial balance. So after that, you move on to your trading profit and loss account. The essence is to determine your gross profit and your net profit, as the case may be. Then thereafter, balance sheet is prepared to know the position of asset, liability, and equity at a particular point in time. Then after, interpretation of financial statements, which simply is done using ratio analysis. So this is a pure diagrammatic representation of the basic structure of accounting. If you have questions, do feel free to ask in the comment section and I will explain better. Thank you for watching.